Please get ready for a dictation of transcription number 354 and 355 from Sir Kailash Chandra magazine. 5 seconds. Start. Sir, a memorandum explaining the various provisions of the finance bill as originally presented has already been circulated to the honorable members along with the budget papers. The few changes since made in the bill by the Lok Sabha at the instance of the government are of a minor character. These changes, which are the result of a careful examination of the various suggestions made by the honorable members of both the houses and representations received from outside, are intended mainly to remove hardship in certain special types of cases. The reasons for making them have already been explained in the Lok Sabha. I do not therefore intend to weary the House with an elaborate explanation of the several clauses of the bill as passed by the Lok Sabha, but shall confine myself to explaining the structure of the bill in general terms. Dealing first with direct taxes, the provisions of the bill are in two parts. One part deals with modifications in rates of taxes. In this category are three provisions. One relates to personal taxes, in which small increases have been made for incomes over Rs 70,000. Another change is a modification in the scheme of corporation taxes. As explained in the budget speech, this scheme is an integrated whole, and the provision for a tax on the occasion of issue of bonus shares follows from the fact that the dividends are based not on capital employed but on the paid-up capital. If therefore the base is widened by the issue of bonus shares and consequently the super tax payable is reduced on that account, it is only reasonable that a small tax should be charged on the occasion of the issue of the bonus shares themselves. The tax is not on the shareholder but on the company. The third provision relates to taxes on registered firms. The justification for this tax is to levy a small charge for the benefits that accrue to partners on account of their corporate functioning. In order that small people may not be adversely affected, we have already changed the original provisions of the bill to the extent of having a free slab of the first Rs 40,000 of the income, which will be free from that tax. Now, equally important from the point of view of the revenue resources of the government are the other provisions of the bill. The most important of these provisions is the amendment of Section 34 of the Income Tax Act, by which powers are being taken in certain circumstances and with certain safeguards to reopen past cases of tax evasion since the end of the Second World War. In the budget speech, the Finance Minister has traced the developments leading to this provision, and I have already explained about the judgment of the Supreme Court, which has necessitated certain changes in the Income Tax Act, and therefore all I need say at this stage is that while every possible care would be taken to ensure that there is no undue harassment to the honest taxpayer, we are determined to collect the legitimate dues of the government. As I have often said before, it is our intention not to collect a rupee more and equally not to collect a rupee less. In this category of provisions should also be included in the powers proposed for search and seizure of documents and for obtaining information from banks. The tax on registered firms will also assist in checking a form of legal tax avoidance by which Hindu undivided families create partitions, whole or partial, on paper and then function as registered firms. In our budget estimates, credit has been taken of the recoveries due on account of these cases of tax evasion. In excises, only three major proposals have been made. These are an additional duty of 6 paisa per square meter on all categories of cotton fabrics except coarse, dhotis and saris, a new duty of 6 paisa per pound on vegetable, non-essential oils, a duty of 25 paisa per gallon on diesel and vaporizing oil, and of 15 paisa per gallon on industrial fuel oils. The duties on diesel and fuel oils are really not on fresh imports, They are mainly in substitution of import duties of about an equal order, the revenue from which is being lost by total replacement of imports by indigenous production at the new refineries in Bombay. The House would be aware that since these proposals were first announced on the 20th February 1956, we have reduced the duty on cotton and seed oil to one half, namely from 6 paisa to 3 paisa per pound, by way of a substantial incentive to the better and greater utilization of cotton seed, a considerable proportion of the oil content of which is now being wasted in the country. In regard to the duty on diesel oil, some anxiety has been expressed about its effect on the agriculturists. We are not satisfied that there is any need for relief. Sir, it is some time, nearly 3 months, since I had the opportunity of speaking in this House at length on the provisions of this bill as it was originally presented to the Lok Sabha. Honorable members may recall the general discussion on the floor of this House and the appraisal which was given to the bill. During the period that the bill has been before the Parliament, it has been subjected to a wide variety of comments by individuals and institutions representing various shades of opinion. These have all been taken into consideration, and after due deliberations, certain amendments were proposed by the government. These have been considered and incorporated in the bill as passed by the Lok Sabha. Honorable members are undoubtedly aware of the various provisions of the bill as originally introduced. The provisions were explained briefly in the explanatory memorandum issued by my ministry and circulated to honorable members. A further note explaining the various taxation proposals in greater detail was also subsequently circulated. I will not therefore weary the House by going into these provisions again and shall therefore dwell chiefly on the salient features of the amendments that were incorporated in the bill during its passage in the Lok Sabha. Sir, so far as personal taxation is concerned, the main emphasis of the critics has been against the lowering of the exemption limit on personal income tax and the reduction of the income tax burden on the higher slabs of income. On these points, I have been at pains to explain the objectives of our taxation policy. I had mentioned in my budget speech that the main reason for reduction in the existing rates at the higher levels of income was that in practice very high rates of direct taxation at the top brackets of income tend to erode the tax base and encourage tax evasion. It is no doubt true that the maximum rate of income tax and super tax applicable to the top brackets of income is proposed to be reduced from about 92% to a little less than 77% for earned incomes and 84% for unearned incomes. But this reduction in marginal rates is not to be viewed in isolation. Under the tax pattern, income tax does not stand by itself. It is supplemented by the wealth tax and the expenditure tax. I have also pointed out on the floor of the Lok Sabha only recently, and I would like, if I may, to repeat here that I have stated there that the integrated tax structure that has been proposed in the budget this year makes it necessary that the tax system should be broad-based. The existing exemption limit of Rs 4,200 is an unduly large multiple of the average level of income in this country. This should be reduced to such a reasonable level as would widen the sphere of taxation and release the tax base from its present inelasticity. It is only reasonable that persons within the lower income brackets should also make their contributions, however small, to the state revenues. With development, more and more persons will come within the income groups which are now brought within the purview of income tax. Furthermore, with the income tax net cast wider, it will facilitate checking of tax evasion in the immediately higher brackets, which is a very important consideration so far as the lowering of the limits is concerned. After amendment which I sponsored in the Lok Sabha for providing some relief and encouragement to the middle class investor, relates to the increase in the normal surcharge exemption limit by the amount of dividends received on equity shares, subject to a maximum of rupees from 1,500. Sir, this has been brought in largely because of a complaint that has been made that the tax on companies would unduly affect, which I do not think it would. Nevertheless, the opinion is that it would unduly affect the position of the small investor in equity shares. Relief is sought to be given to him this way that the cumulative effect would mean much greater relief than as if we made a refund of 0.5% to him of the companies collected. By another of my amendments to the bill, the additional surcharge of 15% on unearned income has been separated from the other two surcharges in order to put it beyond doubt that the proceeds from the former, viz. The surcharge on unearned income, will form part of the divisible pool in which the states are to participate. Stop.